Tom Bowley, Chief Market Strategist here at EarningsBeats. Good morning, everyone, and welcome to this Tuesday, November 21st, 2023 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be with you for the next 30 minutes as we try to figure out what's going on in the market and hopefully try to figure out where it's going. Do want to mention a couple of things. First of all, this will be our last show until next week because of the holidays. I do want to wish everyone a happy Thanksgiving. And if you are going to be traveling this weekend, please be safe. Make sure we get to see you again next week. But enjoy your weekend. Have a great time with family and friends. And the market will be waiting for us when we all get back next week. A couple other things. Number one, we are starting our fall special today. I'm going to go over that with you in just a minute. But that has begun. It's our best deal of the year. If you've been following us for a while and you like our market analysis, you like some of the calls that I've made and so forth, and you want to be a paying member of EarningsBeats, of course, that helps us. I think it'll certainly help you. This is the best time of the year to do so. So we're going to go through that. As far as the futures go this morning, right now, I've got Dow futures down about 0.25%, S&P down about 0.3%. NASDAQ down about 0.5%. So getting a little bit of selling today. The NASDAQ, which just reached a high that took out its July high. So it powered right through 16,000 yesterday on the NASDAQ 100. Seeing a little bit of profit taking. I don't think that that's horrible, especially with the gains we've made so far in November. Let's see if I can get you the Russell 2000 this morning because that was getting hit just a little bit harder. IWM right now this morning, down about 0.75%. So seeing a little bit of selling in the small caps, really across the board, but a little heavier in the small caps this morning. The 10-year Treasury Yield, relatively flat, maybe just up, if we round it, up 1 basis point, 4.43%. And crude oil down another 80 cents, right at about $77 a barrel. Energy been having a lot of problems of late, mostly due to the lower crude oil prices. For those of you that are new to the stream, I want to welcome you. Certainly appreciate you tuning in. Make sure you let your friends know. We'd love to have more and more folks come in, tune into Trading Places Live. I think we take a little different approach to the market. I think it's a better approach, but of course, maybe I'm just a little biased. But I think our results have, certainly speak for themselves. Be sure to like our video and become a subscriber. That will help us if for whatever reason you're not in a position to become a member of EarningsBeats. We still could use your help in terms of helping to grow our channel and to grow our brand here at EarningsBeats. So anything you can do to help there, that would be great. For those of you that are new, welcome. I think you're going to enjoy maybe a little different approach, like I said, that we take at EarningsBeats. And, not listening to the news. I stay away from that. I just kind of focus on the charts and I tell you what I think based on what I'm seeing on the charts. Usually it's bullish, especially when we're in secular bull markets. Some folks label me perma bull. And if you want to call me perma bull, that's fine with, I can't even say it, but if you want to call me it, that's fine. I just call it like I see it. And usually the market goes up. History tells us that. When I do see bearish conditions or clouds on the horizon, I absolutely point that out. All right, I want to talk a little bit about the special that we have. So if you go over to EarningsBeats.com, you can scroll down pretty much right in front of you, but it's our fall special. It's our best deal of the year. If you are currently a monthly member, you really should be signing up for the annual under this special. If you're a non-member, this is a great time to at least start your trial because you've got, I don't know, maybe 10 days of this fall special that you'll be able to sign up. So if you come in, you check us out right now, you can get started right here with your no-cost trial. And then over the course of the next 10 days, if you really like the service, you're not going to get a better deal than right now. And you get the rest of your 30-day trial, by the way. So if after, next week you say, hey, I want to jump in, but I don't want to lose the rest of my 30-day trial, you're not going to lose it. Anything that you add as a result of the special will be tacked on to the end of your 30-day trial. So you're not going to lose out on anything. Just check us out, see what you think. I think most of you will probably be a pretty good match, but leave that completely up to you. If you click on this fall special, you will see that this runs through Sunday, December 3rd. So it's a week from this Sunday. So you got a little bit of time to kick the tires if you want to do a 30-day trial. Like I said, this is the best time. And here is the deal. Normally, our monthly rate, if you sign up after 30 days, you want to continue, you don't sign up for the annual, you're going to get charged a monthly rate of $147 a month. And you'll see that down here. Whoops. You'll see that right here at this little asterisk. If you sign up under the fall special, you'll get a year for $997 and 2 bonus months. So you'll get 14 months. And if you're on your free trial, throw that month in. You're going to have 15 months for the price of 12. And that works out $71 a month, which clearly is a lot cheaper than $147. So if you like our service, make sure you step up to the annual. 2 years, you're going to pay twice the $997 or $1994, but now you get 6 free bonus months, which brings your monthly cost down to $66. And then finally, this is the best offer we have. If you're going to commit to 3 years, we're going to give you a free year. So you're going to pay $2,991, but that's going to be for 4 years, which brings your average annual cost down to $750 and your monthly cost to just $62 a month. That's a far cry from $147 a month, saving $85 a month under that plan. Anyhow, if you do decide, fill it out on this particular page, because this will update our records without us having to manually do anything. So it's just going to help us on the administrative side. But if you fill it out, go down here at the bottom, you can pick out which plan you want and then fill out the rest of the form, and we will have you set up. If you have any questions at all, you can email us at support@earningsbeats.com. All right, let's go ahead and take a look at what happened yesterday. Dow Jones Industrial average up another 204 points. S&P 500 up 33. NASDAQ 100 powered forward another 189 points, gaining 1.2% in the process. That was the best gainer. And you can see the move right there through 16,000. Back in July, we didn't get through 16,000. So remember the correction on the NASDAQ 100? Yeah, neither do I. We've broken back out. That's how quick this move was to the upside. I've been saying it all year. Fourth quarter, we're going to get a scream to the upside. I think we're seeing it right now. NASDAQ 100 busting through 16,000 for the first time since that July high. Now it's probably, I didn't look, but it's probably maybe 500, maybe 3%, 500 points from its all-time high. We're not far from the NASDAQ 100 breaking to an all-time high. Also, check out the AD line, which has just absolutely soared back to a new high. That was, as we were going lower, the AD line was going down, but now we can see big move back up. In my opinion, this is just confirming the price action. Mid caps gaining 10 points, IWM or small caps jumping up a point. On a percentage basis, those were 0.4% and almost 0.6%, respectively. Dow Transport's up another 1/3%, continuing to push up, finishing just under the 15,000 level. I think a big level, and we got almost right up there a few days ago, but that big level is closer to about 15,250. If we could get through that level, I think that would be a really good sign for the transports. And then, of course, anytime the transports are moving, that's like my economy barometer, if you will. That's telling us that things are expected to pick back up down the road with the economy. Anytime the transports are moving up, transports only move up for one reason. That's because the market's expecting them to ship more goods. That's the only reason. There is no other reason to get into transports unless you believe they're going to be shipping more goods, and the economy is going to strengthen. So it's always nice to see the transports coming back off of those lows, pretty scary lows that were put in back at 13.5. We're up more than 10% off those lows at the end of October, which is good. I'm continuing to watch the AD lines on all these other indices. They're obviously not nearly as strong as we're seeing on the NASDAQ and S&P 500. But, those are my two key benchmarks anyway. So those are two that I follow the closest. Moving on to the sectors, technology leadership yesterday, you can see gaining 1.45%, communication services gaining 1.1%, real estate gaining 0.75%, a little bit more than that. So those were your three leaders yesterday. And then moving on to the industry groups, renewable energy off of the horrid correction that it went through from July through really into just maybe a week or so ago, maybe a week and a half here in November. But it has rallied back very strongly from about 240 back above or close to that 300 level. Intraday, we've gotten through 300, still trying to get that close above. And that's where we kind of struggled back in October on the reaction high. Couldn't get through 300, went to a new low. Well, we're now back down to back at that 300 area. Really need a push from here. But you can see renewable energy, that PPO, trying to move back through the center line. That would be a really good start, getting through 300 and getting through that center line, starting to turn the tables on the bears with the bulls beginning to gain more control in this group. Software and semiconductors. What can I say? These two groups have been leading the market throughout 2023. First sign of renewal of the bull market here, end of October, early November, well, really throughout November, and software and semiconductors to the rescue. These two groups have been absolutely powerhouses in 2023, and they typically are powerhouses during secular bull market advances. These are the groups that really are going to help you outperform the S&P 500 because the groups are crushing the S&P 500. Before I move on, I did see an article earlier this morning. I wanted to just touch on that for a second. Over 80%, most of the earnings now are in for the third quarter, and over 80% of the companies beat estimates. That compares to the average during most quarters or during all previous quarters. The average is roughly about 66% of companies that typically beat. And going into this quarter, and this happens every quarter, by the way, which is another reason why you just ignore what's going on in CNBC, because they always talk about the earnings slowdown. It's going to be really bad this quarter. It's blah, blah, blah. They were projecting S&P 500 earnings to be down 1% for the third quarter. It was up 6%. And if you strip out energy, because energy with lower crude oil prices, energy really struggled. I think energy lost, I don't know, 10 or I don't remember what the percentages I saw, but energy stocks were down on average earnings year over year. If we strip out energy and just look at all the other sectors, the other 10 sectors in the S&P 500, the average gain was 12% earnings year over year. So remember all this talk, rhetoric about the Magnificent Seven and how that's the only thing leading the market to the upside? Well, I pointed out over the weekend when I looked at the last month, 200 S&P 500 companies were beating the S&P. In other words, it wasn't just the 7 stocks leading the market to the upside. 200 of the 500 were beating the S&P 500 to the upside. And then throw in the earnings data that says not the Magnificent Seven, but 10 of the 11 sectors in the S&P 500 have averaged moving up 12% earnings year over year. And the expectation for the S&P was to be down 1%. They're always lowballing estimates, which is why the months prior to a new calendar quarter, I'm talking about March, June, September, and December. Those are the 4 months that typically struggle, especially those high octane growth stocks. If you look at them, those 4 months can be a problem. And when we are going to pull back, that's when growth tends to pull back. So just keep that in mind, because you're getting all these warnings about earnings not going to be great. Those stocks, those growth stocks pull back, and then we come through with great numbers and the growth stocks shoot up. That's the way the stock market works. You know, I call them, the influencers, the market influencers. When you get the Goldman Sachs folks coming on CNBC, they're going to tell you what they want you to hear. And they're not necessarily going to tell you what the truth is, and not going to try to educate you to the degree they should. Anyway, I'm done with that rant for today. But don't trust what you're hearing on CNBC. Look at the charts. Follow the relative strength. throughout the entire correction, 3 months, the entire correction, all of the aggressive growth stocks were actually putting in higher lows and higher highs. That's what you want to see. Market going down, but rotation bullish. That tells you it's not going to stay down. Wall Street during a big downtrend doesn't just, power or, jump into all of the aggressive groups only to lose their money. That's not the way the market works. They make money. We've got to figure out what they're doing. And the way we figure it out is through the charts, through relative strength, through the AD lines, following price action. That's the way you do better in the stock market. Stop listening to the news. 10-year Treasury yield. This morning, we see it up a little bit. Actually, it's come back down again. So now it's down almost a basis point, back to about 4.41 and a half, 4.415 in that area. Looking probably next for a close below 4.4%. The head and shoulder top is complete. We have confirmed it with that big down move that broke the neckline. I see the 10-year Treasury yield on that measurement alone dropping to about the 4.10% level. That'll certainly help mortgage rates. We're seeing a lot of folks moving into, on the charts, a lot of folks moving into the home builders, the home construction area of the market. And you might say, what the heck would you do that for in November? Well, ironically, this is the best time of the year to be in those stocks. Forget about interest rates. I'm talking about historically. November, December, January, February, right in this time frame in the winter, that's when home construction stocks make their biggest moves. Doesn't really seem like common sense. I've talked about this plenty of times, but you would think maybe springtime is when money would rotate into, because that's when things start to pick up. Market looks ahead. Market is already anticipating the spring. So that's why you get the December move up in home construction stocks. Anyway, that should certainly help the economy as we go forward because of the potentially lower rates on mortgage loans. That mortgage loans are tied pretty closely to the 10-year Treasury yield. All right, moving on. Let's take a look at some of the major indices. I'm going to actually pull up the Dow here. Still got probably about 300, 400 points to get through the July high on the Dow. And if we stretch this out to a weekly chart, you can see after topping at the beginning of 2022, right at about that 37,000 level, been doing, here was the cyclical bear market, which I said was over. I actually called bottom back here in June. We went down a little bit lower. Then we've rallied back. I believe we're now have been resuming the secular bull market. And in my opinion, it's just a matter of time before we take out all-time highs across all the major indices. First one to do it is likely to be the NASDAQ 100 because we are getting strength from those magnificent seven. They're the best companies in the world. They're very innovative. They have great customer service. Their products are unmatched. Their competitors can't keep up. They got a ton of cash on board. So they don't even have to build things within. They find a good company they like. They just spend their cash and go buy it. They've got huge advantages. I personally think it's a great thing that these seven companies are doing well because they employ a large number of people and it's growing every single day. We want these companies to do well. I don't understand the folks that are saying, well, we need the rest of the company. The rest of the companies are much smaller companies. I mean, yeah, we want everybody to participate, but I personally want the Magnificent Seven to lead. I don't know why anybody who's investing in the S&P 500 or the NASDAQ, why would you want the seven top market cap weighted stocks to start underperforming? Makes no sense. These are the best companies. They're going to outperform. They've been doing it for years and years. Why does the S&P 500 go up at 9% a year? Mostly because of these innovative companies that grow their market caps and become leaders. Again, those Magnificent Seven are really important to us, and I have no problem whatsoever with them leading. I think it's awesome. I think it's really extremely bullish, but I don't know, count me in the minority. Everybody else seems to think that's a bad thing. S&P 500, you can see also taking out or coming close to taking out that late August high. Still a little bit of work to do to get up to 4,600 and through, which is where we saw the top back in late July. But I think it's just a matter of time. Do we go through it now? Do we come back down? I mean, it's possible we could be in an inverse head and shoulder. Left side of, or this is the left shoulder, this is the left side of the neckline, head, right side of the neckline, which is now slightly upsloping. A move back down here to the 20-day even wouldn't be a horrible thing. I mean, we're kind of spoiled because we've been going up for 3 or 4 weeks, but we're not going to go up every single day for the next 3 months. I think we're going to trend higher, but that includes sometimes pulling back and testing some key support areas. The 20-day would be one. I think the gap support, both the top of the gap support from Tuesday's CPI report, all the way down to the bottom of gap support, which would have been Monday's close before the CPI report, that whole area between 44.11 and 44.59, that is your gap support area. We also have a 20-day moving average, which is rising rapidly, and it's at 43.97. So that 43.97 and the bottom of gap support, 44.11, to me is a really key short-term support area. We're sitting at 45.47. I can't promise anyone the market's going to go up every day. In fact, we're going to have pullbacks from time to time. What I will be watching when, maybe this is starting it, we're seeing, futures actually coming back a little bit from where they were earlier, but still down. I don't know when the pullback's going to come, but when it comes, I would be looking first at 44.59, top of gap support. If that fails, then look for the 20-day in the bottom of gap support. I believe that combination will hold on any pullback. That's my belief. And from there, I think we go up and challenge 4,600. Maybe we go straight to 4,600. I'm just saying, don't freak out if we pull back. The market's not going to go up every single day, even though it has done so pretty much since October 27th. That, by the way, as I've mentioned many, many times, that close, October 27th through January 18th, is our best historical time of the year. Going back to 1950, there is no better time during the calendar year to be in U.S. equities than from October 27th close to January 18th. So does this surprise me? Absolutely not. As a historian, I see it all the time, over and over and over again. Many major bottoms go into the stock market in October. Another thing I point out over and over again, of the last 14 bear markets, 7 of them ended in the month of October. Last year, let's go 2 years here on the S&P. We'll go back 2 years, and I want you to look at the cyclical bear market of 2022. When did we hit the low? October 13th. It was the 7th time in the last 14 bear markets that we have bottomed in October. The market tends to, even if it's just a short-term pullback in October, the market tends to move higher off of that. Look at last year. There was your October 27th, somewhere in here, probably at around 3,800. And then January, we were up at, I don't know, right in here, maybe 4,000. So we gained probably a couple hundred points during that period. But that's the period where the market has a history. 62 of the last 73 years, the stock market has gone up from October 27th to January 18th. So is that a guarantee? Clearly it's not. 62 out of 73. That means 11 years it didn't work. But that's a pretty high percentage. And so when you're investing, certainly when you're trading, you're looking for higher probabilities. You want to trade when the odds are in your favor. It's kind of like, when you go to Vegas, if you sit down at, the one-armed bandit and you play the slots, you're going to receive probably about 79 cents on every dollar you spend. It's probably the worst thing you can gamble on in Vegas. But a lot of people like to sit down. Your odds are not in your favor. Most people are going to lose on them. But it's low money and you can have a big pot, blah, blah, blah. The best odds usually are found at the craps table. But anyway, the stock market is similar. There are times when the odds are much more in your favor. And the more you can put the odds in your favor, the much better trader you're going to be, or investor. NASDAQ 100, there's your breakout above 16,000. Could not make it back in July, but we have just made it here. Really great action on the NASDAQ 100. I see it going higher, but like the S&P 500, when you do have these rallies, you will pull back from time to time. We will go through periods where the bears are going to start to get more confident because we don't, here's a period back in April, we just went sideways before we broke out again. Look at February through middle part of March, coming back down. A lot of folks writing the market off back in mid-March. If you went back and watched the news back then, you'd have thought we were in, the Great Depression 2.0. But we rallied off of it. Same with this correction, 3-month correction. Rallied right back off of it, back to new highs on the NASDAQ 100. IWM, I think, is it's obviously been lagging. It's nowhere near where it was back in July, but it is still trading above its moving averages. It is trending higher. With that gap up with the CPI report on Tuesday, I think we clearly now have an uptrending IWM, which is good. Small caps. Again, it's not outperforming, but it's moving higher, which is good. Anything up is good. To the downside, watch that gap support at the top. Watch the moving averages. I really don't want to go back to the bottom of that gap support. And with that kind of volume coming in and that type of a candle, that's a Maribozu candle, which is a very, very bullish candle, especially when it's accompanied by massive volume. That is just buying all day long, start to finish. So that open right there with all of that buying coming in afterwards, that should provide great support for the IWM on any pullback. And that's down around the 174 level. Let me give you that number. 174.23. Let's see. Transports. Transports trying to get back through that 15.2 level. We'll see whether or not we can do it to the downside again. Watch that gap support. Watch the 20-day moving average. All right, moving on to the chart of the day, I do want to mention one more time, fall special, folks. The best deal we offer all year long. I mean, we try to make it as affordable as we can. We do a lot. I think all of our members would tell you how much information we put out, the research we provide, the stock market guidance. If you've been following the shows, you know the calls that I've made over the last 5 years. They're all on YouTube for you to go back and see. I think the calls have been very clear. They've been with conviction. That's the way I operate. None of this waffling. I mean, certainly in the short term, market can go either way. I'm talking about the long-term calls. You've not once over the last 5 years with the trade war, with the pandemic, with the 2022 cyclical bear market, with everything going on, higher rates, higher inflation, not once have you heard me say that we're in a secular bear market. Despite the movements to the downside, I said we're coming back. We're going to go higher. We're going to all-time highs. Is it going to be this quarter? Is it going to be next quarter? I don't know. But I believe before Q1 2024 ends, we're going to be at all-time highs. That's my belief. I'm not changing it. We'll see what happens. But anyway, check us out. 30-day free trial. And then this sale, which lasts, let me go back over here. I've already got it pulled up. This sale lasts through Sunday, December 3rd at midnight. You have time to commit to save a lot of money on membership. Go check this out. And if you do sign up, please use the form at the bottom of this page. And that is simply by clicking on this link right here. That's what brings up this page. But it'll help us administratively if you use this page. If you use another page, we may have to do some manual stuff to make sure that all your time gets added to your existing, for any existing members. We have to make sure that it gets added properly. So it'll save us administratively. If you have any questions whatsoever, reach out to us at support@earningsbeats.com. We'll get back to you promptly. So that's that. Make sure you check us out, though. We've got a lot of happy members at EarningsBeats, I can tell you that. Chart of the day. So and by the way, on that home page, if you go down, there's an area to sign up for our free newsletter. That comes out Monday, Wednesday, Friday, 2 paragraphs in a chart. Very simple. No credit card required for this one. So if you want to just learn more, get used to, the way we approach the stock market, we do this for that reason. So make sure you sign up for the EB Digest. So, of course, today is Tuesday. We only do one Monday, Wednesday, and Friday. So on Tuesday and Thursday, Trading Places Live, I'm basically giving you another one. And this is one that I mentioned to members back on late last week. I don't remember, it's Thursday or Friday, but this is TGTX, TG Therapeutics. It's on our short squeeze chart list. This stock has 27% of its float short. The float is the number of outstanding shares that are available to trade. That's what the float is. So when you've got 27% of short percentage of float, what that means is that folks have gone to their brokers and they said, I want to short TGTX, and 27% of all the outstanding shares of TGTX have been borrowed by traders to then sell those shares. So it's a oversupply, if you will. And many times stocks that are heavily shorted are done so for a reason. People short for a reason. And many of them just drift lower and lower and lower and lower and lower over time. They're not good buys. However, when a stock begins to take out some key levels, like this gap resistance area right here, when it starts to take out some key levels and the volume begins to pick up, it can force anyone who is shorted over the last 4 months, in this stock's case, TGTX, anyone who has shorted this stock over the last 4 months is losing money right now. And to the extent these gains start to mount, remember, when you short a stock, if you sell it and then you have to buy it back, those losses are unlimited to the upside. You don't know how high a stock can go. Remember GameStop when it went from $7 to 500 because of that ridiculously high short percentage of float? Now, this one isn't nearly that high in terms of the short percentage of float, but 27% of all outstanding shares is a lot of short sellers. They're going to have to start thinking long and hard, if this stock keeps going up, about buying. So not only are you getting technical traders that are buying the breakout, but at some point you might see shorts begin to panic and cover to avoid more and more losses. And that can drive a stock like this much, much higher in the near term. So anyway, TGTX, I think, is a great short squeeze candidate. Short squeeze stocks, if you're going to play them, they're incredibly risky because a lot of times they move up. You can even get false breakouts, and whoever is shorting just digs their heels in and puts even more into it. We might see TGTX fail and move down again, and next month we might see the short percentage at 40% or 50%. So it's no guarantee. But for those who maybe have, I talked about Vegas a little bit earlier, for those who have a gambler type mentality with trading, this is the kind of stock that can move very fast to the upside. So this stock could be $20 in a couple of days. I'm not saying it's going to be. I'm just saying the conditions are right. These short squeezes, it's a stock market inefficiency is really what it comes down to. It's where all of a sudden, if prices move up, and by the way, TGTX had a great earnings report back here with this gap up. That's one of the reasons why it's going up. The fundamentals look better. Revenues crushed estimates. Earnings per share crushed estimates. And now we're breaking out with a lot of shorts having to make a decision. So if we don't see a quick reversal and a close back down below, I think the number is 1188. 1188, that was that gap right there. That was the open that day. So we went through 1188. Unless we go back down and close below 1188, this thing's got possibly much more movement to the upside. You can see today down 38 cents. Let's see where it is by the end of the day today. Could go back and test that 1188 area, by the way, like it did yesterday. But anyway, keep an eye on that. Last thing I'll do here, I know market just opened. S&P 500, I just wanted to show you that during this move to the upside, we are getting relative strength in the technology area, consumer discretionary area, the communication services area, even coming back a little bit in industrials over the last maybe 2 weeks. And then financials since the latter part of October have actually started to gain strength. These are all the aggressive areas. And you can see even during the weakness from July to October, we didn't do badly in technology, continuing to move up. Communication services kept moving up on a relative basis. And discretionary was fine until this September to October move where we did see prices go lower. But these are aggressive areas that money is rotating into when the market's going down. That's why for me, it was an easy call to say this is a correction. We're not going to continue moving lower. Wall Street firms don't move into technology as the market's going down, preparing for a crash. That's not the way this would have worked. So anyway, I use that to my advantage. It's one of the beneath the surface signals I like to use. Here are all the other sectors. So again, S&P 500. Here's healthcare moving to new lows. Consumer staples, new lows. Real estate, basically new lows, starting to show a little bit of relative strength. Yeah, real estate right there. Then we got utilities here down near 52-week lows. Energy struggling. Materials hitting a 52-week low. All of these groups, the top four are defensive areas. These two at the bottom, energy and materials, are more neutral areas. All of those are losing ground while aggressive stocks are gaining ground during a correction. I mean, you can make whatever conclusion you want, but my conclusion is that it wasn't going to last. And here we go with the market to the upside. All right, quick update on the overall market. You can see Dow Jones down about 0.25%, same with the S&P. NASDAQ down a little bit more, 0.4%. Small caps getting hit harder, down about 0.8%. But again, watch the IWM. I think it was at 174.23 level. It'll be down, but we should be still well above that. Yeah, I mean, we're down about 0.85%, but 174.23, still another $3.50 away. We do have some room for a little bit of profit taking. All right, that is it for me. Again, I want to thank everybody. Please like our video. That'll help us. If you're watching the recording later, certainly help us in that regard. Subscribe to our channel anytime we go live if you're subscribed. I think you've got to you got to turn on notifications. I think once you do all of that, you're set to go. Anytime we go live with anything that's free, you'll be notified. So there's certainly reason to do that for you, and certainly reason to do it for us because it'll help us. The more subscribers we have, the more views we have with YouTube's algorithms. It just gives us more exposure out there. So help us out if you can. Everybody have a great Thanksgiving. Again, no shows tomorrow. For members, there'll be no live trading room. It's Wednesday before Thanksgiving. There's a lot of folks traveling, including some of us here at EarningsBeats. So please have a safe holiday weekend. Enjoy your time with family and friends, and enjoy the long weekend away from the market. The market's closed on Thursday. It is open half a day on Friday. As far as our daily market report that we normally send out Tuesday through Friday, obviously none will be out on Thursday for Thanksgiving. Friday, maybe not. Just depends. I mean, usually it's a quiet day. And if it's a quiet day and we're not really doing a whole lot, no major breakouts, breakdowns kind of a thing, probably not going to have a daily market report. Probably just chill, maybe catch up on some things I'm still a little behind on here at EarningsBeats. So anyway, enjoy your long weekend. Have a great holiday. And I'll see you at the end of the holiday next Tuesday for your next Trading Places Live. Happy trading, everybody.